Let's take a look at the anatomy of the accounts, specifically the contra asset account, allowance for doubtful accounts, uncollectible accounts, or bad debts, the current asset account, accounts receivable, and bad debt expense. We know that accounts receivable has a beginning balance at the first of the year. It's increased when we debit it when we have credit sales, meaning we debit accounts receivable and we credit sales. We know that when a customer pays, we debit cash and we credit accounts receivable when the customer pays, which makes accounts receivable go down. We've also just covered that when we write off a particular account, we debit the allowance account and we credit accounts receivable. I know your name and I don't like you. So here's where we have the write-offs, where we said we debit the allowance and we credit the accounts receivable. So those two go together. And we also talked about the recovery. And the recovery first was we had to put them back on our books, which is debit accounts receivable, credit the allowance. Here's the recovery. And second, take their money, which is the customer pays, debit cash, credit accounts receivable. Thus, we know that the ending balance in accounts receivable, that's the only thing that can happen there. Also, at the end of the period, we know that we're going to make an adjusting journal entry, and it's going to be for an estimate. And that estimate is based upon either an accounts receivable method, which is known as aging, where it calculates the desired ending balance in the allowance for doubtful accounts, or we're going to use a method that's based on sales, and that sales method instead gives us the amount of the expense. So this is the key takeaway that you want to remember after the next couple of videos, that the aging method gives you the EB, the ending balance, whereas the percentage of sales method gives you the expense, and then you have to compute the ending balance. So more on that adjusting entry in the next video. Well, let's see how we can use this for a problem. So this problem asks us basically to figure out the proportionality between the allowance account and the accounts receivable account. So for Emerson Electric, we're told what the allowance balance is and what the accounts receivable balance is, and we're asked to compute the percentage. So in 2011, the allowance account estimates that about 2.3% of the accounts receivable are not going to pay. That's our estimate. Whereas in 2012, we think it's only about 2.2%. So did it increase or decrease? It decreased. So we must be much more optimistic about our customers' ability to pay their receivable bills. Part B, the bad debt expense does not agree with the ending balance in the allowance account, and we know that's true because the allowance account ending balance has a lot more things going on in it. Besides the estimate, we have write-offs and we have recoveries, whereas the bad debt expense is just the amount of the expense for the period that's trying to match the expenses with the revenues that were generated that period. So that's it for a problem. See you soon.